Physical Gold Fund presents the Gold Chronicles with Jim Rickards and Alex Stanczyk. Insights and analysis about economics, geopolitics, global finance, and gold.
Hello, this is Alex Stanczyk, and welcome back to another podcast for the Gold Chronicles. I have with me today Mr. Jim Rickards. Hello, Jim.
Alex, how are you?
Excellent. Thank you very much. We covered quite a few topics in our last podcast, which includes the risk in cryptocurrencies. We talked a little bit about the G20. We talked about Syria, talked about North Korea. On the North Korea topic, you've been saying for several months now that at some point the U.S. will go to war with North Korea to eliminate the risk that Kim Jong-un might actually nuke a U.S. city. Now, you even mentioned it live on Bloomberg at one point in the last few weeks. The staff there was pretty skeptical of the idea. However, an hour later, North Korea fired its first ICBM.
That was one of those amazing coincidences. I wouldn't have said one thing differently if I had known about the test in advance, which of course I didn't. But if whether it was happening or not, I wouldn't have said one thing differently. But they say it's good to be smart and better to be lucky, and sometimes things converge in a way that plays out. But yeah, I mean, it's a serious subject. But literally, I was on the air live with it was Bloomberg Asia, interestingly. So Bloomberg has a 24-hour cycle. They don't have separate networks for their different regions. They just keep going. So it was 7:00 at night where I was actually in Montreal, 7 a.m. in Hong Kong and Singapore. So we were live on the air to I always say 2 billion people in Asia, so big potential audience, and that's exactly what we said. And the was a great interviewer. So, but I always say it's not the anchor's job to make me look good. That's my job. They're there to kind of hold your feet to the fire. And we had a co-host, and there was a fair amount of skepticism. But then I said I was very categorical about the march to war. We can talk more about that. And then literally minutes later, the news breaks that they just fired an ICBM. People weren't sure it was an ICBM when it went off. It looked like one. Then subsequently, that was verified by a number of sources. So certainly not a good development. What was interesting about that dialogue, Alex, and when I do these interviews, including our podcast, I'll put them out on Twitter, try to expand the audience a little bit. But I can see some, not all of the clicks. Bloomberg will obviously see more than I do. But that interview got more clicks than anything I've ever done outside of a couple of things that just kind of went super viral. But normally, if you get 1,000 or so views, that's pretty good interest. And this one sort of went off the charts, had over 6,000 views in 24 hours, so which is a lot for a TV interview. So that definitely got a lot of attention. But what was interesting, the point I was going to make, is that my co-host, very well established, reputable money manager, he was sort of disparaging gold. I was taking the pro gold side. And then I went into the thing about North Korea. He said, well, if we're going to war with North Korea, you would definitely want to own gold, as if we weren't going to war, which, again, not a amusing exchange, not an amusing topic, unfortunately. But my point is, well, we're going to war. But it was a really good example of the cognitive dissonance or the denial of and the complacency, for want of a better word, of professional money managers. Like, oh yeah, if we're going to go to war with North Korea, I'd load up on gold. It's like, well, we are. It's happening. It's happening in front of your eyes. You can see it with the 6 months to 1 year lead time. So why don't you get some gold now, an attractive entry point? Why? What are you waiting for? And the answer is they always wait until the first shot is fired, and then gold will be who knows what, $500 an ounce higher, $1,000 an ounce higher, and then they'll run out and buy some, at $1,375, $1,400 an ounce, when you can back up the truck right now and buy it for $1,240. So I never understand it, but it is what it is.
Yeah, pretty typical. For our listeners, if you haven't heard our previous two podcasts, we talk about the North Korea situation in depth. I recommend you go check them out, as well as the last one we just did. We talked quite a bit about the risks in cryptocurrencies, which I think people are starting to explore further. For today's topics, we're going to begin with a few thoughts on physical gold. We're going to discuss a little bit about the U.S. economy. what the Fed is watching in terms of its metrics, Fed policy is in terms of easing or tightening, and we're going to wrap up a little bit with some discussion on a little known problem in the Chinese financial system, or I should say Chinese financial markets. So beginning with physical gold, I recently just got back from a family vacation. We spent some time panning for gold in the Black Hills of South Dakota. And Jim, as you well know, panning for gold is a labor-intensive process. Our little group of 7 people, we spent about 4 hours moving earth. And what that means is we would dig these buckets of earth out of these massive tailings piles that was left over from the gold excavation operations and the gold rush back in the 1870s. So a tailings pile is basically just leftover dirt that they sort of sifted through looking for gold. But the thing was, they were using these screens to find the gold that had these huge holes in them. And back then, they expected to find gold nuggets in much larger size than we find today. But this tailings pile made up the entire side of the riverbed we were on. And even with all of the time and energy we expended, again, there were 7 of us, and we worked for 4 hours doing this, we ended up with less than a gram of gold. And some of this reflects the concept of what's called high grading, which basically means like all of the super high ore deposits in history that we've found mostly have already been discovered. I mean, everything that we're doing in mining operations today, we're talking large-scale mining. It's not uncommon for a large-scale operation to require a ton of earth moved to find just 1 or 1.5 grams of gold. So the point that I'm trying to make with all of that is that gold is really stored energy. The energy cost of extracting gold from the earth is now and has always been considerable. I contend that along with physics, these are the 2 primary reasons that gold retains its purchasing power over thousands of years. Jim, you do a bit of panning yourself in your top secret personal location. I'm not going to ask you to divulge where that's at, but tell me a little bit about your experiences there and why gold's physical properties make it ideal for storing value over millennia.
Well, thanks, Alex. And I do a little bit. I should make it clear that I do it for fun and teach my grandchildren a little bit about where gold actually comes from and how scarce it is. So we do it as a recreational thing. I'm not trying to pay my property taxes with my gold output. You at least had the benefit of tailings, where there was some reason to believe that there was some gold around. I'm panning in an area where there is gold. Certainly not in commercially viable quantities, and it's also a very environmentally sensitive place, a very green place, which is a good thing. It's unimaginable to me that anyone could ever get a permit to open a mine. But there are old mines from the 1850s in my vicinity, and there is gold in them dar hills, as they like to say. In fact, this area was affected by Hurricane Irene in 2011, and there was a bit of a gold rush. People were buying gold pans from the local stores, and believe it or not, running down to parking lots of shopping centers because the earth had literally been stripped off the face of the surrounding area, and it kind of drained into these lower lying areas, and there were just mud piles and water caches and so forth. And they were panning for gold in these parking lots and finding some. So there is gold there. I find it a gram would be a lot to me. If we found a couple flakes, that would be good. But we do it for fun. But it does make a point, the point you were making, which is this is a known gold mining area, at least back in the 19th century, and it is extremely scarce. And I have visited recently commercial gold mining operations, up in northern Quebec, real gold mines with real development and a lot of drilling going on and equipment moving in. So kind of the real deal. But even there, you're exactly right. It takes a ton of ore, rock and earth and so forth to maybe get a gram if you're lucky. So and that would actually be quite high. It's usually measured in fractions of a gram. So that's how scarce it is. And it would be one thing if you could say, okay, well, I'll get a gram of gold per ton of ore. If you could do that any place you dug up, but you can't. I mean, what I'm talking about, as you say, is a high grade location. Those locations are few and far between and seem to be getting more scarce. The other point I would make about gold mining output is that we're talking about very long lead times. Now, what happened, of course, we all know that gold had a magnificent run, one of the great bull markets in history from 1999 to 2011. It went up from about $200, I'll use round numbers, about $200 an ounce, maybe $199 an ounce at the low, to almost $1,900 an ounce. So you're looking at 1,000% gains, 10 times your money in a relatively short period of time. Then it had a major correction, came down about 50%, which is interesting. I think I've said in past podcasts, I mentioned my conversation with Jim Rogers, one of the great traders, period, but particularly one of the great commodity traders of all time, co-founder of the Quantum Fund, along with his partner at the time, George Soros. And Jim told me he's bullish on gold. He owns gold. He holds gold. But he's never seen a long-term bull market that didn't have a 50% correction along the way. He said that's just the way it is. So you get to 1900, gold back down, the low. The interim low or the cycle low was 1050. That was just over a 50% correction if you use 200 as your baseline, as your starting point. And it's been going up since then. It's up over 20% since then. So it looks like that is behind us, and we're on to bigger and better things. But here's my point. So 2011, 2010, 2011, you can only imagine the gold rush fever that was going on, not just in Canada, but around the world. And people were, investing. Capital was easy to raise. A lot of mines were opening up, et cetera. But then a lot of that was priced at, $1,300, $1,400 an ounce, or not really feasible when gold went down below 1,100. So you can well imagine the sort of gold fever that was going on, not just in Canada, but also around the world, when gold was soaring up to $1,900 an ounce. And if your production costs were, $1,100, $1,200, $1,300 an ounce, you could get financing, and you could bring marginal properties back into production, et cetera. Well, when gold went down, certainly to 1,300 by April 2013, then even lower by 2015, those mines were suddenly non-economic. There were a lot of bankruptcies. A lot of projects were called off. Projects were halted in midstream. Other projects went bankrupt, et cetera. And then you just had no, or at least very little, exploration and mining going on in 2013, 2014, 2015 as the price was kind of treading water. What's happened now with the price back up in 1250 and a good upward trend, we'll talk about that in a minute, is that the mining fever is picking up again. But you can't just pick up where you left off. It takes, if you're talking about a greenfield, which is you have an attractive opportunity, you get the mining rights or you lease it, and you start exploring, you start drilling, you do your feasibility studies, you get your financing started. That takes 5 to 7 years before you can bring ounces onto the market. Now, some opportunities are the time horizon is shorter than that, because you're literally maybe stepping into the shoes of somebody who went bankrupt at a much lower price point, and you kind of pick up where they left off. So, and there's some mines that were never shut down. But as far as new production, we're in a trough right now. It's going to take years to get production up close to where it was in terms of capacity, if you even could. So it's we all know the demand is sky high. We see that in Russia and China, India, and elsewhere. Supply is tight. You and I have been around the world meeting with whether it's refiners, miners, vault operators, dealers, et cetera. You hear the same story everywhere. It's amazing. It's really, really hard to fulfill orders, get your hands on gold, et cetera. So the technical setup on the physical side could not be better. Of course, we have our old friend, the COMEX, and anyone that can sell 60 tons of paper gold with a phone call to a broker with no actual gold involved. Obviously, you've got that's occasionally a headwind, but that will fade in time.
Yep, totally agree. So to wrap up our gold commentary, I'd just like to make a quick observation in that I've noted sort of a continual shift in the views of institutional money managers when it comes to what they're allocating to, and that is when they're evaluating the risk in the ability to get liquidity on their assets. It's starting to become a big concern. This makes sense considering the fact that very little has been learned from the past couple of previous crises. I mean, I was just recently looking at your most recent book, Jim, and you were talking about this concept that Wall Street is basically still clinging to the notion that net exposure is what matters, when gross exposure is where the risk really lies, and Wall Street hasn't come around to this view yet. So, just for any financial professionals, money managers who are listening to this podcast, if you're conducting due diligence on gold funds, one area that I would encourage you to look specifically into is how those funds are buying and selling their gold. That's the Achilles heel, and I think you're going to find that they all do it through banks, which is, in our opinion, a big mistake.
Well, they either do it through banks, which leaves you very vulnerable, or they're buying paper gold and expecting to be able to convert it to physical gold. You know, the big gold banks, as you know, Alex, are the members of the London Bullion Market Association. There aren't that many. I don't know the exact number. It's 7 or 8, but they're familiar names. You know, Goldman Sachs, HSBC, and a few others. But when they sell gold, and again, you have to read the contracts carefully, they do it on what's called an unallocated basis, which means all you really have is paper price exposure. They don't have the actual gold. They might have, 1 ton of gold, and they sell it 20 times over. So they're short 20 tons of paper gold, backed up by 1 ton of physical gold. Now, what happens if the longs, the holders of the 20 tons of physical gold, all show up at the same day and say, excuse me, I'd like to convert my unallocated to allocated, and I'd like to take physical delivery, and I'm sending my Brinks truck, and they'll be there in 15 minutes. Well, there's no way that they can satisfy those deliveries. There's no way. What they would do is basically terminate those contracts, send you a check for the price differential. So, yeah, you would get your paper profit up to that point, but that would only happen. See, this is the conditional correlation that Wall Street does not seem to understand, or at least does not want to understand. The world in which the holders of the 20 tons of paper gold all called up the same day to take physical delivery, that's a world where gold's going up, $200, $500 an ounce, per day. Stocks and other paper assets are crashing. There's blood in the streets, as they say. There's a panic. It's when you most want your gold is when you will least be able to get it if you don't already have it. And that's why I've always encouraged those who want exposure to gold to have physical gold in safe non-bank storage. You don't have to worry about delivery. You don't have to worry about fine print and contracts. You've got your gold. Obviously, make sure you're dealing with a reputable fund or provider, or a fund that's backed up 100% by physical gold with no delay. Some of these ETFs, by the way, I'm not saying there's anything dishonest about any of this. What I'm saying is that people don't read the contracts, or if they do, they assume that they can convert when the time comes, and they'll find out the hard way they can't. But that said, some of these ETFs, they take you buy a share of an ETF. That's a secondary market transaction. You're buying the GLD share on the New York Stock Exchange. You're not buying gold. You're buying a share, number one. And when the seller sells to a buyer, that has no impact on the amount of gold in the ETF itself. That only happens when one of these authorized dealers chooses to issue new shares, and then they have to buy gold, deliver it, then they get some new shares. So they can expand the floating supply of shares, if you will. But there are leads and lags in that process. They can issue the shares, and then you can take up to 28 days or so to deliver the physical gold. So the point being, there are, whether it's the ability to terminate a contract on either a force majeure clause or an adverse, material adverse change clause, the ability to delay acquisition of physical gold, the possibility of closing banks, the possibility of futures exchanges ordering trading for liquidation only. There's just a whole long list of things that can go wrong, and none of them are a substitute for physical gold. By the way, going back to my Bloomberg interview we talked about earlier, Alex, when I was on with this money manager, it was sort of supposed to be one of these pro-gold, anti-gold debates, and he was against gold and I was for it. But it turned out, the more we talked it through, he said, well, we're not totally anti-gold. We allocate from time to time. We're in and out of it the way we're in and out of other things. And, occasionally we'll take up to a 5% allocation. And I said, well, that's interesting because I've never recommended more than a 10% allocation. I've said put 10% of your investable assets in physical gold, not 50%, not 100%, but 10%. So I said, look, if you're occasionally a 5% guy and I'm a 10% guy, we're actually not that far apart. This is a little bit of a phony debate because we both see a role for gold in portfolios. But here's the point. Institutional exposure is 1%. So whether you're with this money manager who occasionally did 5 or whether you're with me and I recommend 10, they're both a far cry from 1. And if the world of institutional investing even moved from 1 to 3 or 1 to 2, forget 5 or 10%, there's not enough gold in the world at these prices to satisfy that demand.
You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.